model. Before I drop down into a lower time frame, I just want you to know that this is the next draw on liquidity I'm looking for. And if we expand on the downside and say dollar explodes on the upside, this level here and some of this area over here, maybe 50% of this would be sufficient, about right here. That would be the next downside draw if dollar rallies. Okay, I think it could still sweep these lows here and still be bullish and allow dollar to go lower. Okay, we're at a crossroads where it can get really sloppy for a short period of time and then explode and go one-sided. I just don't know which side it's going to work off of first, and I need to wait. Again, if you're new here, it's going to be like, well, you should know better than this, ICT. Come on, I'm paying you. No, there's a couple times where, every quarter, every 3 months or so, there's going to be a period where I need more information. And it just so happens to be today we're doing a weekly review, and you're expecting me to tell you, okay, I'm pointing here, and now you shoot and try to hit that. We've already done that. Okay, we've already done that with this level up here, and it was fulfilled again for last week. This week, I am not confident at the moment right now as to know which side of the marketplace it's going to reach for, because it's fulfilled our weekly objective for last week, minimum. And it's fallen out of bed a little bit since it's done that. So I don't know what next week holds, and I have to wait and play it by ear. So if we lose ground in cable, just be mindful that these two equal lows and these two equal lows have a large pool of liquidity. Now, here's something that can also happen. Draghi says something and causes the market to have all kinds of wild price action. It could clear both of these, come down and fill in half of this, stop about right here, and then send it higher, which would be a remarkable long-term signal, because it would get rid of all of these short-term highs here. Okay, that would people would be seeing this when it breaks down. They would see that as a long-term bearish top and continuing lower. If we get a reaction down here and climb back above the mean of this consolidation, okay, the equilibrium of the low to high, or actually it's this low because it's lower, this low and this high, draw a line through that, okay, and if we come down below these lows and trade back above that, wow, that is really, really bullish long term. And I will be all over cable for the rest of the year on the long side, building up a big position, because I believe that it would send us up into the 28s. So that's what I'm anticipating and forecasting if the scenario presents itself. But again, that's a lot of speculation, because I don't know what the central banks are going to do relative to the sentiment that is basically engineered by Draghi speaking next week. Okay. All right, so take a look at a 15-minute time frame, and everything is going to stay the same here, just going into a lower time frame. So you have a consolidation. We leave the consolidation and run up into our pool of liquidity, which is that old daily high. Price hits that, smart money reversal, break in market structure. Right there, that low is taken here. Here's your low, 25.54. And here is your low here, 25.54. Zero. It's 2 pips below. Is that all it takes, Michael? That's all it takes. 2 pipettes. The price runs back up. Fair value gap. Bearish order block. Sell off. Boom. Smart money reversal here. Low risk sell here. Redistribution. Sells off again. Sells off again. Fair value gap entry here. Sell off. I actually tweeted this real time. Asked you, what do you see? And that's exactly what was supposed to be seen in that. I was trying to draw your attention to that for folks that are in the mentorship. It doesn't matter if you missed it. It doesn't matter, because I do a whole lot of that stuff every week on Twitter. It goes over a lot of people's heads that are outside the mentorship. But when I do that, I'm prompting you all, not them so much, you. You know better. So the market reaches down into a pool of liquidity here. And again, you watch me do the run on liquidity below this low here. I was looking for a little bit deeper of a run to take out the 2440 level, which still, in my opinion, may be the near-term draw on Monday going into Tuesday. So just watch that going forward. And then I got stopped out on the remaining portion, which I also shared on Twitter today. So again, this is an exercise. It doesn't always pan out, but that's the point of practicing. You will go in and you engage price. Work on low resistance liquidity runs. Everything that you learn in month one content, that is the basis for you to be practicing every single day. Even if it's in hindsight, look at your charts and look at it from with the benefit of hindsight, obviously, but go and look at it from a low resistance liquidity run, because they're occurring all day long. They're all over the place. Inside of all this stuff here, there's low resistance liquidity runs. I mean, this high here, which is a fair value gap entry, an order flow entry drill, this high here, let me get it to pop up here. That high, 25, 44, and 8 pip bets. Once it trades to that high on this candle here, that's a short with a run below here and a run below these equal lows. That's a practice session. That's a drill. And if you do that over and over and over again, you condition yourself to look for these runs on liquidity. And then if you apply it to longer term time frames, man, you got everything you're looking for. 25, 30, 50, 75, 100 pips, whatever you're looking for, you can do it in a weekly range. You can trade on both sides of the range. It doesn't matter. You'll know what you're looking for, because of the run on liquidity is the basis of what makes these markets move around. Longer term, it's interest rates, but short term, it's all volatility reaching for liquidity. That's it. That's all it is. So when you get that understood and you can see it visually in the chart, it's everything outside of the chart. The charts stop with these candles here, but the liquidity below that, that's what we focus on. The fair value inside of these imbalances, that's the other thing we work on. So external range liquidity, internal range liquidity, okay? External range liquidity, internal range liquidity. Now you're probably confused. I teach that in the mentorship if you haven't got that far, okay? But just know that there's a balance, an ebb and flow, okay? Just like the market moves from discount to premium and premium to discount, it moves from external range to internal range to external range. It's always that move back and forth. The algorithm reaches for all those elements. And when you get the narrative understood at the time when you're looking at price, that's when your bias clicks. That's when your long-term analysis clicks, and you are dialed in. You know exactly what you're looking for. And I can't stress the importance of making that your goal. Not money, not how much you're going to earn, and not how many pips. You need to know how to anticipate and forecast price movement, because that's what this mentorship is. You're learning how to read price. You will know without me saying it that there's going to be a time when you transition, because of your decision, not mine, when you go into live trading. And you'll know when that is the right time for you. And I'm not going to say anything more than that, because we don't teach live fund trading here, because I'm not licensed and regulated to do that. But I can talk all day long about a demo account and tell you what that demo account is going to do. It's up to you to decide what that means for you as a trader. And you know what I mean by that. So this is a market maker sell model. They go from a consolidation, they ramp it up, running the liquidity above this high here. The high is 25.59, and the high on this candle comes in at 25.82. So it reaches for institutional, but again, the level was the old high. So from a pip perspective, 59 and 7, so it's essentially what? 60. So 10 pips above that would be 70, 20 pips above that would be 80. And we have that level on the daily chart at 25.79 or whatever it was. And it basically calibrated to what? 80, institutional 80. Look how many times it hits 80. 1, 2, 3, 4. So you had an entire hour to get that as an upside objective and close out any longs that you would have had back from over here or over here. Okay, so a very challenging week, admittedly. This was not an easy week from a higher time frame trading standpoint. Intraday, it's business as usual. And that's why, again, I teach the scalping, because the long-term daily charts, right now, people don't know what they're doing. I don't even know what it's going to do. But inside that single daily candle, Man, I can find 50, 60 pips all day long working off a 1 minute chart or a 5 minute chart. That's why it's important to learn that, because you don't need to be a higher time frame trader. You don't need to be a swing trader. You don't need to be a short-term trader. You do need to know scalping. You absolutely need to know it, because if you understand scalping, all you're doing is changing your time frame, and that changes your model of trade. Position if it's on a long-term weekly chart, swing if it's on a daily, short-term on a 4-hour chart, day trade for an hourly chart, scalping for a 15-minute chart. It's as simple as that. It's all scalable. And because of that scalability, is that even a word? If it isn't, I just made it. If you understand that benefit of being able to scale your understanding of price in fractals, you can go into any time frame and trade it. It's not forcing you to only be able to day trade or scalp. That's not what this is. And it's a very myopic opinion for people that come in on 1 month and they see I do a lot of work with that, and they think, oh, I'm not going to be a scalper, and they leave. They have cheated themselves. One of the most powerful understanding